Hey there, Kai here. Now today I'm actually in one of my newest and latest rentals, a nice historical mid-century modern home just minutes outside the city. Now it's a little bit different than what I normally use and rent out, but I think it's gonna do really well with this new style, and we're getting a chance to actually do a little bit of light remodeling, painting, and furnishing it with stuff that I don't normally furnish with. Mid-century modern furniture. So I'm kind of excited to see how it's gonna do with guests. Now, a lot of times when we think about revenue and making money, we think about how much rent and how much revenue we can create with our properties. But what if I told you there's something even more important? It's how much you get to keep after taxes. And in most cases, state and federal governments, they can eat up to about 40–50% of your taxable income or your rental income. But today, I'm gonna share a couple of really nice tax deductions if you own a property or you make rental income. And that includes how I travel the world and drive a Tesla, all because I make rental income. Let's talk about it. Slap hands, bump fists, let's roll. Now, if you're coming back from my last tax video, welcome back. And if you haven't seen it yet, I talked about what Mr. Sam is going to want from you when it comes to properties and rentals. You can check it out right here. Now, I know most of you out there, probably all of you, are not huge fans of taxes, and I'm with you. But it does go to good things, even if we may not all agree with how the government allocates that money. With that said, tax avoidance is highly encouraged. You should never want or naively give more money to the government in taxes than you should have to. Lying and putting false numbers on your tax return is called evasion and is highly discouraged, and you could face significant legal issues. Don't do it. But you're here to talk about vacation rental tax deductions that can help you keep more of your profits and maybe have a little bit of fun doing it. Batter up. First is what I hinted in my last video. Qualified business income. So this comes after all of your other deductions have been made, but I wanted to share this first because it's something that most new landlords and hosts aren't really aware of, and it could save you thousands, even in the tens of thousands of dollars each year. Now, after all of your other deductions and depreciation, which we will get into next, you get another tax break. This qualified business income deduction, aka QBI, is also known as pass-through income deduction. The QBI deduction is actually really cool. The QBI deduction allows you to deduct as much as 20% of your pass-through business income. This includes income you receive from a pass-through entity such as an LLC or an S-Corp, which you should have for your rental business. Now, rental income from an investment property falls into this category. There are taxable income thresholds though. Boo, I know. We can't have everything we want, but the thresholds are relatively high, $315,000 for married taxpayers and $157,000 for all others. If you're under these thresholds, you can take an entire 20% deduction. Now, this can get kind of complicated depending on your tax return and what you got going on, so be sure to work with a licensed and well-established CPA. I've got my personal friend who is a CPA who I'm trying to help build his business down in the description below. I stand behind his work and I highly recommend him. His name is Kevin, and tell him I sent you. The second thing most folks forget about and don't know is depreciation. Now, this is perhaps the largest and best thing about owning a rental that allows highly profitable investment properties owe little to zero taxes each year. Again, it's not the rich man getting richer, but just the wise understanding the game that's being played. Depreciation is the best tax advantage you and I get as property investors. So how it works is how we write off legitimate business expenses. Let's say that you buy $100 in toilet paper for your rental, which is considered a consumable supply for your rental business. That $100 is deducted from your tax return. On the other hand, assets such as large machinery, cars, and your property are deducted over time through depreciation. Since real estate has a useful lifespan of more than a year, which we hope, the cost of purchasing rental property is deducted in this manner. Residential rental properties are deductible over 27.5-year period, 39 years for commercial properties. If you buy a residential rental property, you can divide the cost of acquiring that piece of property minus the value of the land by 27.5 to determine your annual depreciation deduction. Now, guys and gals, This is huge. So for example, you buy a rental property for, let's say, $200,000, and let's estimate that the land is worth $50,000. We do some hard mental math. 200K minus 50K equals 150. You then take the 150 and divide it by 27.5, giving you $5,500 roughly. Now remember, this is in addition to everything else. So let's take one of my properties that makes roughly, say, $30,000 a year in rent. After I subtract out all of my other expenses associated with owning and running the rental, my taxable income is now $7,500. Now, if I had purchased the property at $200,000 minus the $50,000 in land value, I get to subtract another $5,455 from that $7,500, and now I only owe roughly $2,000. Now remember, we can still apply up to 20% for the qualified business income deduction, which takes off another $400. So what we just did there is 100% legal. We took $30,000 in taxable income and we reduced it down to a couple $1,000. And what we call that is tax avoidance. But there's something you should never avoid, and it can actually get you in a lot of trouble. It's avoiding that like button and subscribing to the channel to catch me in future videos on how to hack, grow, and make money, specifically through saving, investing, and real estate. You won't regret it. Thanks. Okay, with the two heavy hitters out of the way when it comes to rental tax deductions, let's get into the more fun stuff, which can also get you to travel a little bit. Now next is number 3, travel expenses. Now I know this seems straightforward, but it can be a bit murky with the options you have at hand. Because you're driving back and forth between all your properties, you may just want to buy a vehicle and write it all off right away, which is a newer tax code. Or you may want to write off your lease payments. But let's say that you're just starting out and you're getting your first income property and you don't really need a dedicated vehicle to get around. You can write off the mileage you drive to and from the rental and any other errands that are related to said rental. You just have to document it. I personally use the app Driver's Note, where I can just hit a button and it immediately starts tracking my trip. At the end of the year, I download the mileage and send it off to my CPA, Kevin. And for each mile, the government allows you to write off 56.5 cents to help cover maintenance, gas, and depreciation of your car. Check with Kevin on the exact numbers because it's always changing year to year and depending who's in office. So you probably already knew that one. That's pretty straightforward. But this is where things can get a bit interesting. One of the major advertising sites, VRBO and HomeAway, is located in Austin, Texas. Every year they hold conferences and meetups there. There's actually tons all over the world. But let's say I want to attend one of the conferences for my business. I have to get a plane ticket, rent a car, buy meals, and everything else that's related to that trip. That's all tax deductible. Now, some of my closest friends live in Austin and I love the city. Just because I'm going there for work doesn't mean I can't visit my friends and have fun in one of my favorite cities. I'm able to generate a tax deduction for something that's helping me with my business and also having a little bit of fun. Now, if you watch a lot of my other videos, you see me using this tax advantage in other aspects of my business to travel all over the world. Number 4 is one of my favorites because it's how I've made hundreds of thousands off my properties: upgrades. When you remodel your home, you have to pay for the entire project out of pocket, and that's it. When I upgrade or remodel an investment property, and you know I like to buy them a little bit beat up, everything I spend on the remodel is a tax write-off. After I finish my upgrade, not only did I do it cheaper because of the tax deduction, but I also significantly increased the value of my property, which doesn't only mean higher rent prices, but it also means higher resale value down the road. Number 5, maintenance. One of the biggest headaches of owning a property is maintenance, not just because of the time, but the expense. With rentals, there is a silver lining. You can write off all maintenance issues that you have to deal with. Not only do you keep your guests and tenants happy, but you ensure you keep the value of your property high and the rental in good function for years to come. Now, after dealing with dozens of properties, maintenance is one of the most glanced over or overlooked areas for rentals, especially when it comes to long-term rentals. Don't do that to your tenants or your investment. It can get you in a lot of legal trouble and it ends up costing you far more money in the end when you have to replace the water heater, HVAC system, or even worse because your house flooded or burned down because of basic maintenance that wasn't done. I've personally seen this happen when fires were started because somebody didn't clean up the lint trap, or floods happened because bathtubs and plumbing wasn't kept up to date. Number 6, supplies. Any supplies you get for maintenance or to make your guests comfortable is fully tax deductible. So anything from cleaning supplies, toilet paper, and soap are all legit business expenses. You can even go above and beyond and use this as a reason to put in nice artwork, furniture, and plants inside your home to not only stage it well, increasing the value, but also attract better and more guests. One little thing that I do extra that falls into my category is I buy guests tea, coffee, and snacks such as cookies, candy, and popcorn. They're little things that I get to write off and really enhance the overall experience of the rental. I highly recommend it. And the last one that most of us know, but is still a good one to talk about, is mortgage interest, HOA, insurance, utilities, and all other bills directly related to your rental property. This has always been a nice benefit because it really reduces the financial strain of holding on to an investment property. Just remember, any expense that you have to spend to hold on to your rental and run your business or your Airbnb business can be a legal tax deduction. Now, a couple things to keep in mind. Here comes the rain on the parade. Well, more of a sprinkle. The government will always get their share of the dollar. The biggest one is with depreciation. There's something called depreciation recapture when it comes time to sell your property. Kevin, the CPA, can explain this in more detail to you, but you'll only have to pay this if you sell your property for a profit. Now, I'm making this video in 2020, and the tax laws are always changing, and I'm sure I may have crossed a few numbers and probably misremembered some small details. So be sure to work with a good professional to iron out all the creases to help you save that money and get you into your next rental property, or perhaps even your first. You're all amazing, and I thank you so much for your support and wish you luck in your property investment journey. Take advantage of these deductions. It can really help push you into this realm of financial success and live a life of traveling around and having a lot of fun. Now, if you made it this far in the video, tell me down in the comment section below so I have an idea of the number of people I didn't bore to death with tax talk. Help me out and like this video if you liked it, subscribe and join the family here in our little corner of YouTube. You can click right here on this icon, and in a little bit, I'm gonna put up 2 more videos right here and right here I think you may find interesting, where I talk more about how I got out of the rat race at 27 and now I live off of rental income and travel the world managing my portfolio remotely. I love you all. Kai out.